I am John Howard, and today's short video is a crazy simple rental strategy, which is the formula to retire early. Don't wait to buy real estate. Buy real estate and wait. That's a quote from Will Rogers. Okay, so while there can always be an ongoing concern about economic instability and recession everywhere, or what's going on with the economy, especially now, here we are, it's 2025. It's wise to always consider ways to secure your wealth and cash flow in the future. If you are strategic with your investments early and follow financial sound strategies, maybe you'll have the opportunity to retire early or earlier than average and get yourself the leisure time and vacations that you want if that's what you care to do with your time. But for that to happen, you will obviously you'll need to make some investments. You'll need to start making some investments now. Now, obviously, there's a lot of different investments anybody can make, but the spirit of this video is making investments on real estate. Here, this is going to be, a very simple strategy of making investments, on real estate, getting good mortgages, paying those mortgages down, and then realizing property and equity appreciation. This is called long-term planning. So here is a dive into this very simple retirement strategy, which is the investment property acquisition and rental strategy you can, or anybody can, consider to achieve a very reasonable and achievable retirement. So one of the keys here to not missing this opportunity to plan out and achieve a retirement for yourself is to recognize that it is important to act now and make an investment and continue to, evaluate investments and continue to make investments. Obviously, these investments need to make financial sense. They have to, that comes into long-term planning, right? In terms of what are the rents going to be? What are the expenses? What is the appreciation kind of factoring? In terms of the savings or liquid capital that you have, you should be using this. I'm not advocating 100% of it, but you should be using your liquid capital or savings in acquiring assets. And these assets, again, for the spirit of this video, is real estate. And it's real estate investment property that you would acquire and you would rent out. And these properties should appreciate over time. While I'm going to highlight a lot of benefits to these real estate investments during this short video, one of the great things also about real estate is it tends to keep up very well with inflation, or it has proved to do so over the last many years. So unless you already have a very high income meaning $100,000 or more, it is important to consider investment property as part of your strategy or as your main strategy before buying your first property if you don't already have a property. Meaning, if you're going to make your first investment, and again, this is if you're a high income earner, it's a different story. But if you're not a high income earner, your first property purchase to live in it can be a little bit challenging. And the reason is basically because there's a lot of expenses that come along with owning a property versus being a renter. And without naming all the different expenses, the main ones that you'll have as a property owner above and beyond what you would see as a renter are principal, interest, taxes, insurance, maintenance, and repairs. So maintenance and repairs are usually the big one that kind of, even as when you own investment property, that can kind of throw off your numbers a little bit because sometimes you'll have maintenance and repair expenses that pop up. Now, having said that, what's interesting is even for me, years ago, my first property acquisition actually was with my brother, and we purchased a condo in Santa Monica. And we just thought it was the right thing to do, and it did really work out. I mean, we had a very attractive mortgage at the time, and we only lived there for 2 years, and we sold it, and it worked out. And then the properties that I actually acquired after that, I did move into them, but shortly after moving into them, I moved out of them to then turn them into rentals. So, assuming that you're going to turn this property into an investment property, here we are in modern times. It's 2025, and there's really there's basically never been as many options in terms of renting the property out in history as there are now. Now, when I say is now, I mean, I've been doing short and medium-term rentals for about 20 years. I mean, even did short-term rentals before Airbnb. But with Airbnb, as big as they are, it obviously opens up, the opportunity for people to do short-term rentals pretty much all over the country, right? Well, obviously all over the world, but certainly all over the country. Here we are. This video is primarily for the U.S. So really, the three main options that you have are going to be long-term rentals, medium-term rentals, and short-term rentals. Those are going to be your main options. Now you can have something exotic where this is also does fall under the classification of short-term rentals. But for example, some people will go and do very elaborate acquisitions, and some very large groups will do like corporate events or very large family gatherings with lots and lots of people. And those are more, or even like business masterminds kind of thing. That's a separate thing. I mean, that for the purposes of this video, that's going to also fall under short-term rentals. So personally, I've actually done medium-term rentals mostly lately, and over the longest period of time, I've done mostly medium-term rentals, which is, some people refer to that nowadays as mid-term rentals. I typically call it medium-term, but that's 30 days or longer. The reason I like medium-term rentals is because on average, your typical monthly average cash flow is the most stable and the highest when mostly doing medium-term rentals, at least in my experience. And I found that medium-term rentals is exponentially less work than short-term rentals. Obviously, you can do long-term rentals, but really the difference here is that short and medium-term rentals are going to be furnished, and then in that case, you're going to be taking on the expenses of power, water, and internet, which is really not that much of an expense when you actually factor in the fact that, at least in my experience, short and medium-term rentals have been about 2 to 3 times the average monthly revenue as long-term rentals. Obviously, that also depends on the area where the property is. Now, something else I've actually also done is what I call a hybrid of short-term and medium-term. So with the hybrid, at least for me, it's really, I like to just do it during the easiest time. And the easiest time is really, at least I'm in Southern California here, so at least that, let's say, May or Memorial Day to Labor Day, right? So Memorial Day to the September timeframe. And then also, during the holidays, really just the winter holidays. I mean, you could certainly rent Thanksgiving, but that's really only a couple days, whereas it can also be very busy during Christmas and New Year's. Okay, so after, that concept, that's really just the cash flow of the property, right? Bringing in the rental income and cash flow. After the cash flow and hopefully the profitability of the rental, we have appreciation of the asset. So assuming that you can get an attractive 30-year fixed mortgage for the property, what's going to be happening is you're going to be, this is, very important reason why it's good for retirement, is you're going to be paying that mortgage down over time. So for the purpose of this example, it's going to be 30 years. So you're going to be, paying down that mortgage for 30 years. So in this example, you're going to have 30 years, and it's going to be like basically, this slow moving ship where the property is appreciating over time, and then you're paying the mortgage down over time. So you're building wealth in between what you purchased the property at and then what its new value is. And then also you're building wealth through forced savings. And I don't know about you, but I mean, it takes, these days it costs a lot of money to live. You can just be spending money on this and that. And it is, in general, a very good plan. It's very good to have a plan in place where you have forced savings through paying the principal down of the mortgage. So an example here would be, let's say you're able to get an investment property for $500,000. Now in this day and age, here it is 2025. I don't know, that might be a little bit low, but I think it's still possible. So let's say 500,000. So if you are able to get that investment property for 500,000, and let's just say you have an average appreciation per year of 5%. Some people might use the figure of 4%. Some people might use the figure of 10%. It seems to me that 10% is probably very aggressive, but let's say 5%. So here, in this example, if we use 5%, the property is going to be worth approximately about $815,000 at the end of those 10 years. And then the mortgage is going to change. So the reality is that the mortgage companies are going to have their own way of calculating the way that principal paydown works. But for the purposes of simplicity in this video, we can keep it very simple. And let's just say, okay, it's going to be basically a mortgage. You put 5% down. So your mortgage, instead of 500, it was 450. So 450,000. that's going to be $1,250 per month of principal pay down, and then that's going to be $150,000 over 10 years. So instead of having a $450,000 mortgage at the end of 10 years, you're going to have a $300,000 mortgage at the end of 10 years. So if this property is worth $815,000 and your mortgage is only $300,000, then you now have equity of $515,000 at the end of 10 years for this one investment property. Now here, we've really just covered asset and equity appreciation, and we've covered mortgage paydown through forced savings, which are all great things for long-term planning. We haven't even covered the tax savings. So when it comes to tax savings, basically what's going to happen is you're going to get the IRS offers pretty much any real estate investor depreciation. So you can depreciate that property typically over something like 39 years. That's very standard. There are also things like bonus depreciation. So if you're doing short-term rentals, even medium-term rentals, there's going to be a certain portion where you can write off, certain things more than the standard depreciation, right? So like just for example, instead of 39 years, you could write off in 20 years, or you get bonus depreciation of 60% of your purchase price in the same year for things like appliances and flooring and fixtures. And that's going to be depreciation. So that's a set amount each year. And the great thing about depreciation is it's a non-cash expense. Non-cash meaning it doesn't cost you any money out of your pocket. You just actually get it each year. Now, in terms of income and income tax, the IRS has 3 types of income classifications: active, portfolio, and passive. Active income is from your job, your salary, or your business. Now, what's interesting here is that active losses can offset active, portfolio, and passive income, but passive and portfolio losses cannot, they don't operate the same, so they're not going to wipe out active income. So the IRS has, traditionally classified rental income as passive for many years because people have been renting real estate for a very long time. It's more recent that we're now doing short and medium-term furnished rentals. So with the advent of short and medium-term furnished rentals, the IRS, it gives you the ability to materially participate, right? They call it material participation. So in this example, the IRS requires you to spend more than 500 hours a year at the property, or on the rental, not at the property, sorry, on the rental business, or spend more than 100 hours and more than anyone else, or substantially more than anyone else on the business. You do need to hit these 100 hours. So, if you think about that, that's actually not too difficult. 100 hours, that's, less than 10 hours a month. That's like 8 hours a month, or a little bit more than 8 hours a month. And, you don't even have to be at the property the whole time, and just literally doing emails and phone calls and doing certain work related to the rental operation. 8 hours a month is it's a pretty low bar. And I've certainly done that and been able to qualify for that over the last many years doing medium-term rentals. Now, something to consider is that if you spend 10% of the time or more at the property, then they'll classify it as a residence. So you do have to watch out for that. So this particular tax, and again, this is just the tax strategy. So this tax strategy is actually one of the most aggressive forms of tax savings that pretty much exist, right, in our country. And a lot of, let's say, successful real estate investors are really just high income earners, right, $100,000 or more. As you can see, it's going to be close to impossible to qualify for the material participation if you're doing long-term rentals. But, again, with medium-term rentals, sometimes in a light year, there's can be like 3 rentals, and it's a pretty easy bar to hit those 8 hours per month with even just 3 rentals per year. So as you can imagine, when it comes to this equity, we just showed you how you can go from one property acquisition of $500,000, and over 10 years, you're going to see that net worth up to $515,000. You don't have to stop at one property. You can, start acquiring more. And, as time goes on, you could be, continually evaluating, investments, real estate investment opportunities, and be planning for your future and planning for your retirement. So as you can see, if you're already a high income earner, obviously it's a very effective wealth building and tax saving strategy for you to also help in your retirement outside of maxing out your contributions, your retirement contributions. But if you are, not already a high income earner, you can still do this strategy. The only thing is you're going to actually have to find some partners, and you might have to do some kind of non-traditional bank financing for it. But even in that case, you're still going to be able to realize some very attractive tax savings. And then also, even again, if you're not a high income earner, you might even generate some tax loss carry forwards. If your plan is to replace your 9 to 5 income, you're gonna certainly have to do some calculations on your own to figure out what that income you're gonna need to replace is, and then do your calculations. Now the problem is you can't really. It's just going to be very difficult to just give you an average of what a property is going to make per year, right? So, but if you want to use like a figure like something like $1,000 to $1,500 per property, I think in this day and age, I mean, certainly with short-term rentals, I mean, you can make more of a profit than that. But because acquisition prices are going to be so much higher now that it's 2025, you can use a figure like $1,000 to $1,500. So, like for example, if you want to get to $5,000 a month to replace your 9 to 5 income, you're probably going to need like 3 to 4 properties minimum. So pretty much anybody can, look at multiple real estate investment opportunities. And if you're not already a high income earner, you can, talk to pretty much any partners and look at getting some partners on some deals. So when it comes to planning out your retirement, you're going to want to start looking as early as possible. So if you do the simple math, like for example, I have 2 wholly owned properties that I, have had for a while and I rent. I also have others that I rent out as well, but I'm not, it's not where I wholly own it. But in general, with those, if they do anywhere from $150,000 to $200,000 a year in gross income, that is, you can use that as a gauge, right? So maybe if you had 4, for example, you might do close to 400, gross, and then obviously it depends on your net. But you can actually plan that out and use that as a model, and then get to something like 500,000 to 1 million gross, and however long that takes you to get there with the amount of properties you can do. Now, one thing to keep in mind is, in my experience, again, it's just easier work, and it is typically a little bit more stable to do the medium-term rentals. And also, I mean, maybe you could do long-term rentals if you like that, if you really don't want to leave your job. But you can certainly consider short-term rentals. Where people are these days having success with short-term rentals is very, very premium short-term rentals. Premium meaning $1,000 per night or more. Now, keep in mind, in those cases, you're not going to be very close to 100% occupancy in any way. But the most important thing is that these are going to have a very high acquisition cost. So start as early as possible, keep on looking, and keep acquiring, right? And as you can see from the example where, after the end of 10 years, you've got a $515,000 net worth. Well, if you had 4, then maybe you'd have a $2 million net worth. And then from there, you could do what you want. If you wanted to keep them or if you wanted to sell them, and then, you'd have to do your tax planning from there. But what you want to do is have enough so that you could at least be a millionaire, have at least $1 million in equity, 10 or 15 years down the line. So in a nutshell, that's why I like rentals. You got those benefits of rental income, asset and equity appreciation, significant tax benefits from depreciation and all of the expenses, forced savings from paying the mortgage down. And then you also have the ability to borrow against it. So if you wanted, if the property appreciates in value, you can then borrow against it. And then obviously borrowing it, those proceeds are not taxable, and they can use that to put into the next deal. And lastly, and most importantly, maybe, just maybe, when you pay off one of your properties, you might want to actually retire and live in one of those properties that you paid off. Because obviously, if and when you retire, you'll want your expenses to go down. Thank you very much, everybody. That is my video for today. The very super simple strategy on retiring with rentals. If you found that video enjoyable, you can go ahead and give it a like, maybe subscribe, because I am coming out with a lot of content related to investments and real estate and medium-term rentals. Also, if maybe you know somebody that wants to see this material, you can go ahead and you can send this video to them. And then also, I've done this for a long time. I've done, short and medium-term rentals for like literally 2 decades. I've actually have some products I'm coming out with. They're very incredibly cheap. I'm just, working with a few people to kind of, help them and coach them along the way. It is actually, very inexpensive. You're going to see some links in the description, and you can also see an email address. If you kind of are interested in speaking to somebody, or maybe asking a few questions to somebody that maybe is a little bit further ahead than you are, go ahead and reach out to me. That's the purpose of that. Okay. Thank you very much, and have a great one.